Whole life insurance cash value. Is it a scam? Well, according to Dave Ramsey, it isn't. The only people it benefits is the life insurance agent. Ain't that right?
Independent thinkers and all the people who do financial planning based on numbers and mathematics believe whole life is a ripoff and don't sell it. The only people who tell you it's a good idea are people who sell it.
So it would seem. In today's video, we look deeper into the math and to see if the math actually makes sense. So as a financial planner or financial advisor, someone who worked in money management, we were always taught, number one, that we could beat the market, and number two, that permanent life insurance sucks. So I'm right there with you, Dave. So as time progressed, I thought to myself, well, it can't be all fraudulent, right? It can't just be a scam. There has to be some relevance to having whole life insurance. I mean, I got my licenses to help people with this stuff. It can't just be the term is the only way to go. So then, after years of countless illustrations run and scenarios broken through and people who've come to me and policies that I reviewed, that's why you don't want to hear about all that juicy stuff that I like. What happened? Well, the findings are quite interesting. But first, we do have to go into a bit of background. So, like I said, as a financial advisor and someone who goes to church, I have gotten the Financial Peace University book and even was offered a chance to take the class. Well, a lot of his class is good. It's very good. Getting out of debt, understanding your budget, making a plan, all of that stuff is vital to any personal finance or any financial success by any means. But here's the hang up. He says that whole life insurance is a scam. It'll never work. So as someone who likes to figure out if something truly will never work, I took to the testing. Like I said earlier, countless illustrations. So if this is true, well then life insurance agents only make money by selling really crappy stuff. They're bad people. Why do I have my license? These people, why did they make me take this license? Well, of course, because it's part of the financial picture for your clients and you got to provide a plethora of financial tools so that you can help them. Okay, well, let's go see and find out if all this research from all these companies, all of these industry leaders all say you need to have a life insurance license. Why is it that we need to have one? And is permanent life insurance, whole life insurance, cash value for that meaning, a good place to put money for accumulation? I'm going to put in an arbitrary number of 1722 into a whole life policy. You can see a video where I break down how I got that number in the description below. Let's go and look and see what the whole life policy illustrates as so we can figure out if, hey, is this a good deal? Is this even viable? Here's what I found. So as a 36-year-old male who is preferred health, I'm not unhealthy, but I'm also not, working out every day anymore. I'm playing tennis because of, COVID. So we're putting in $1,722 into a whole life policy that is maximized for cash value growth. And also we're going to stop paying at year 30. It's not a whole life, whole pay, always pay policy. It's just one that ends when you're 66. And that's kind of what I'm going to do with the market, right? I'm going to keep going until 66 and then I'm going to be pulling out money, not putting any more money in because I'm, retired. So here's what I found. I used the guaranteed cash value accumulation. So this is a whole life policy, dividend paying. So I used the guaranteed rates with no dividends, calculated the CAGR of that, and I got 2.03%. So that's the guaranteed cash value accumulation inside the policy, net of fees. And then I calculated what it would be with the current illustrated dividend rate, which turned out to be 5.15%. CAGR. Quite amazing, wouldn't you say? So now we have a whole life policy, maximized for cash value accumulation, returning anywhere between 2% to 5%. Goodness, this is, structured the right way. This is a viable place to put cash on the side to accumulate and to be protected, because unlike the market, the life insurance policy isn't going to lose value because the guaranteed value is the lowest it can go, at 2.03% CAGR. So let's not forget that the whole life policy, even with the guaranteed CAGR of 2%, does still have a $155,000 death benefit if anything were to happen to me during that time. You know, that 1722 over 30 years is only about $50,000. So if I died during that time, I would have gotten 155 grand. And in the optimistic model, that 5.15% CAGR with the current dividends reinvested, we have now $247,000 of death benefits. So not a bad deal, right? Not a bad deal at all. And I know I'd be saying, well, this is optimistic, right? Who pays dividends at their current rate? Of course. But then again, we can't guarantee the market. So what do we do? Well, I personally myself have quite a bit of money in the stock market, as you could imagine, as a financial advisor. I advise most of my clients to put a lot of their money in the stock market, but I also advise them to put money in a whole life policy. And what I feel is a better approach to it is not an all or nothing. It is a blend of whatever makes my client or myself feel more comfortable. Having a whole life insurance be shammed and say it's a scam and all this stuff, well, while that is true for potentially 80% of the policies that have passed through my desk, the ones coming out of my desk are those that are maximized, like the one I talked about today for myself as a 36-year-old male in preferred health. Now, these policies aren't for everyone. It is hard to blanket anything for anybody, but what you do want to know is math, if it actually works out, right? The math doesn't lie. In the case of the whole life insurance policy, we don't have all this up and down. What we do have is constant growth that doesn't change, doesn't waver. You can't get any less than what the CAGR of the internal rate of return of the policy is for the cash value and also for the death benefit. So you essentially have two things working in your favor. While yes, one does cost you money, it's already built into that price, and what's already built in is the numbers that I use. So it's not like I'm using an inflated internal rate of return for the death benefit. All that stuff is not even part of this analysis. So what are the key takeaways from today? Well, the first is to utilize the CAGR whenever you want to really calculate what the true rate or the real rate of return you are going to experience when you retire. That's number one. So what are some steps you can take? Well, calculate your own CAGR on your accounts. Look at how much money you put in, how much money you had in the beginning of the year, and then what you ended up at the end of the year to find out what your true rate of return is. A lot of times in the policy or in your 401k statement or IRA statement, they give you the average annual rate of return for the quarter and maybe for the year. That number doesn't always tell you the whole story. Like I said, you need to find out what the compound annual growth rate is, because, and you can check the video down below about CAGR versus the average annual rate. But you really do need to find out, because that's the number, or that's the real interest rate that your money is actually getting, not the average annual rate. So if you're young, you got a lot of working years left, whole life insurance may be an option for you to consider when planning for retirement or when planning for, your finances. And remember, if you're a financial advisor, insurance agent, client, personal finance person, look at all the tools that you have at your disposal. Don't just focus on one or two because, well, that's what the people on YouTube said. And I'm just one of these other people on YouTube too. So just take my information with a grain of salt. And again, anything you hear in this channel is my personal opinion. Even though I do have licenses, I'm not giving anybody any specific advice here. It is just so that you can get some ideas on what these math numbers look like. And then I hope that in today's video, we helped you make sense of the math of finance. Hope you enjoyed today's video. For more resources on retirement planning topics like Medicare, Social Security, and retirement assets, be sure to subscribe and check back here from time to time for up-to-date resources on retirement planning. Thank you for watching. Have a great day, and God bless.